Imagine you invest $10,000 today, and by the end of 2026, that money could realistically grow to $15,000 or even $20,000 if it is invested wisely. But if you put that same money in the wrong place, it could shrink quickly, and in extreme cases, it could disappear completely. So the real question is not whether you should invest. The real question is, where should you invest in 2026 to grow your money without taking unnecessary risks? Because right now, doing nothing might actually be the biggest risk. Of all, inflation in the United States has cooled from its peak, but prices are still much higher than they were just a few years ago. If your money is sitting in a traditional savings account earning 1%, you are slowly losing purchasing power every year. Even high-yield savings accounts paying 4 or 5% barely keep up over the long term. That is why many people feel stuck. They are afraid of losing money in the stock market, afraid of buying real estate at the wrong time, and afraid of falling for risky investments. So they freeze and keep cash sitting idle, but avoiding investing does not remove risk. It guarantees slow loss through inflation. The smarter strategy for 2026 is diversification. Instead of putting all your money in one place, you spread it across different sectors. So if one area struggles, another can balance it out. Let us break down 6 smart areas to consider. First, the U.S. stock market. Historically, the S&P 500 has delivered around 8 to 10% average annual returns over long periods. Instead of chasing hype stocks, focus on strong blue-chip companies or low-cost index funds. Sectors like artificial intelligence, renewable energy, healthcare innovation, and semiconductor manufacturing continue to show long-term potential. If you do not want to pick individual stocks, ETFs and index funds offer built-in diversification, and for most investors this should be the foundation of their portfolio. Second, real estate. Real estate has created massive wealth in America over decades. Certain states like Texas, Florida, and Arizona continue to attract population growth and business expansion. You can consider rental properties, growing suburban markets, or even REITs if you prefer a more hands-off approach. But always run the numbers carefully, including taxes, maintenance, and cash flow before investing. Third, agriculture and food innovation. Food demand never disappears. Technology-driven farming, vertical agriculture, and ag-tech companies are becoming increasingly important in the U.S. economy. You may not buy farmland directly, but you can invest through agricultural ETFs or farmland REITs, which often move differently than tech or real estate, making them useful for diversification. Fourth, gold and commodities. Every portfolio needs some level of protection. Gold has historically acted as a hedge during economic uncertainty and inflation spikes. Holding 5 to 10% of your portfolio in gold or commodity ETFs can provide stability during market downturns. This is not about fast growth. It is about balance and protection. Fifth, investing in your skills or your own business. This may be the highest return investment of all. Learning high-income skills such as digital marketing, coding, AI tools, sales, or e-commerce can dramatically increase your earning potential. Your income is your biggest wealth-building tool, and many financially successful people built businesses first and invested profits later. Finally, startup investing. Startups can generate huge returns, but they can also fail completely. If you choose to invest in early-stage companies or venture-focused funds, limit it to 5 to 10% of your total portfolio, because this is the high-risk, high-reward portion, not the foundation. So if you had $10,000 in 2026, a balanced example could look like 40% in diversified stock funds, 20% in real estate exposure, 10% in commodities, 20% in skill development or business, and 10% in higher risk opportunities. This creates growth protection and income potential. Remember, no investment is risk-free. Diversification reduces risk, but never eliminates it. Always invest according to your personal financial situation and long-term goals. Now, I want to ask you, if you had $10,000 today, where would you invest it first? Would it be stocks, real estate, your own business, or something else? Let me know in the comments, and if you want more smart money strategies for 2026, subscribe and stay connected. Let us build wealth the right way.